Something historic is happening in the gold market, and if you're waiting for a better time to get in, you might be missing the final boarding call. While the mainstream media was distracted by the latest tech swings, major institutions just dropped a bombshell. JP Morgan and Wells Fargo have officially revised their targets, calling for gold to hit $6,300 per ounce by the end of 2026. That is not just a prediction, it's a 25 to 30% upside from where we sit today. But here's the real kicker, the technical loading phase. That period where smart money accumulates while the price stays quiet is flashing 5 distinct signals that it is officially over. Today, we will be breaking down those 5 signals and why the off-floor for gold has just been permanently raised. Signal number 1 is the death of the $2,000 floor. For years, gold struggled to stay above $2,000. In 2026, analysts like those at State Street are confirming that $4,000 is the new $2,000. Even during recent volatility, where gold touched 5,600 and pulled back, it didn't crash. It consolidated. This is what we call a structural shift. We are seeing higher lows on every single dip. When the worst-case scenario for an asset keeps getting higher, that's not a bubble. That's a revaluation of the entire asset class. Signal 2. Central banks aren't just buying gold, they're addicted to it. We're on track for another 800-ton year in 2026. But look at who is buying. It's no longer just emerging markets. We are seeing a global de-dollarization trade where gold is being treated as the only sanction-proof reserve asset. When the people who literally print the money are trading that paper for gold at record prices, you have to ask yourself, what do they know that you don't? For my chart nerds out there, Signal 3 is the volatility compression. In early 2026, gold's weekly trading range narrowed by a staggering 72%. In physics and in finance, when you compress something that much, the resulting breakout is usually explosive. We've moved out of the messy sideways trend and into a clear bullish regression. With the 21-day moving average holding firm as support, the technical path to $6,300 is wide open. Signal 4 is the macro environment. Despite what you hear about sticky inflation, real interest rates, that's the interest you get minus inflation, are staying compressed. The market is currently pricing in multiple rate cuts for the remainder of 2026. When rates fall, the opportunity cost of holding gold disappears. Gold doesn't pay a dividend, but in a world where bonds are losing purchasing power, gold's 0% yield looks like a gold mine. Finally, Signal 5, the return of the Western investor. For the last 2 years, the rally was driven by the East, China, and India. But in the last few months, gold ETFs in the US and Europe have seen a massive reversal in outflows. Institutional smart money in the West is finally chasing the rally. This is the loading phase ending and the markup phase beginning. When retail FOMO hits the headlines at $6,000, the big gains will have already been made by those watching these signals today. Look, the road to $6,300 won't be a straight line. There will be shakeouts. But with JP Morgan, UBS, and Wells Fargo all converging on this target, the consensus is clear. The cheap gold era is in the rearview mirror. Are you holding, buying the dips, or waiting for a crash that might never come? Let me know your target in the comments. If you found this breakdown helpful, hit that like button and subscribe. We track these signals every week so you don't get left behind.